And I would go further and say that some of the claims that you make speak to human flourishing itself.
Absolutely. Yes. I mean, that's one of the major themes of the book, that U.S. American-style corporate finance is one of the great world success stories of the past 40 years. And why 40 years? Because the book argues that corporate America was failing in the 1970s. It was the companies had turned themselves into bloated conglomerates that were designed to cushion the effects of the business cycle by having lots of different businesses, and they were designed to produce full employment and continuous growth. And everybody was in favor of this, local politicians, managers, but the corporate executives didn't own much stock, and the companies just ended up destroying their own value. They were unable to respond to the conditions of the 70s, to the high inflation, to the regulation. And the 1980s saw a reassertion of investor power and control. Investors began to step in to break up these conglomerates and to force companies to pay more attention to their shareholder value. At one point, the S&P 500 lost half its value during the 70s. So it created this enormous difference between the potential value of conglomerates if separated and their actual market values. So it was an invitation to investors to come in and begin to break up these companies. And managers had to begin to pay attention to their investors. I mean, it was the reassertion of investor control, which was the rule in America in the 1920s, and when the largest investors sat on corporate boards. But everything that happened in the 20s through the 30s was designed to protect companies from their investors. Glass-Steagall, to separate bankers were viewed as the villains. They needed to be separate from corporate managers who knew what was best for society. The assumption was that managers know better than short-sighted shareholders, investors, what to do. Well, the last 40 years has shown otherwise, because corporate America is it's a productivity miracle of the last 40 years that has basically, and companies, there have been some down cycles, but the companies have responded and rebounded from each, and the shareholder returns to American investors have been something like 12% on average for 45 years, and that's probably double the rates of return to the UK. You can correct me if I'm wrong, and certainly the Eurozone, and Japan has been in a 30-year recession since the 1990s, and I draw the contrast between the U.S. and Japan very explicitly. Japan is what happens if you have no investor control over your corporate manager. The managers, the corporate is run to achieve full employment. You're not allowed to fire anybody, and you diversify, you conglomerate, because you want the businesses to be able to insulate themselves from the business cycle. But the net effect of this concern about full employment and risk management is that the corporations are not good at anything. They lose their core competencies, their competitive edge, and shareholders end up losing value. And the consequences of Japan, I go so far to argue, are a declining population. The Japanese population has begun to shrink since 1913. And I may be the only economist who has suggested that there is a link between the productivity of your publicly traded corporate sector and population growth. I mean, not to mention GDP.